Today we have Brandon Hall, a CPA. We are going to be talking about some of the very commonly used tactics that we talk about almost every other week in the mastermind. Mostly accredited investors in there where we're talking about. Always great to get a real CPA to break it down for us.
Happy to be here and happy to help.
So let's start from the top, right? Like syndication investors get passive losses. Maybe if you can break that down and then we can get into how do we use those?
Sure. So when you invest in a syndication as a limited partner, the losses coming back are definitely going to be considered passive. And those passive losses can only offset passive income from your other passive activities. So I could have a syndication that is producing positive net income, and that's passive income. And then I could have another syndication that I've just invested in that's going to push back a big loss from like a cost segregation study. I can use the losses from syndication B to offset the income from syndication A. So you can cancel them out. But if I have net losses, even after I offset all my income, they are net passive losses and they get suspended and carried forward into future years until I can generate passive income or until I sell a syndication investment at a gain. We don't lose the suspended losses. They just sit on our books to hang out until we can generate income to tap into them at some future point.
And one of the main reasons why I invest in syndications these days instead of your little one-off single-family home is single-family homes, you can deduct it over 27 years or so, which is very lame. It's gonna take forever to get that. But with this, when you do a cost segregation, which I typically pay maybe 5 grand to do one of those, I can extract a third of all the depreciation in the first year, distribute that to all passive investors. And I don't know what you're seeing, Brandon, but like typically on an investor load where they're using pretty healthy leverage, 70 to 80% loan to value, they put in 100 grand, they're getting anywhere from 50 grand to over 100 grand of passive losses in the first year. But what are you seeing as you guys put together all these K1s?
Yeah, I think or what we pegged, somebody in my firm was tracking this, and I believe the average was around 92% of whatever dollar you invest is going to come back as a passive loss across all syndicated investments that are out there. So that includes 50s, that also includes hundreds.
You've got to stick 3 to 6 months of reserves in the bank. Can be a substantial amount of money, but it's definitely been diluting the cost segregation a little bit, maybe bringing it down 10%, but still pretty good. Can't complain.
Just never know what's going to happen over the coming years.
And what's a newer thing too that you're seeing a lot in these deals that people are using this different class of investors, private equity, what it's called. It's a fixed rate of return. They get paid first, but they don't get any upside. But the one cool thing is they still are considered equity investors and therefore get a piece of the losses too.
The nice thing about LLCs and syndications is that you can structure them really however you would like. So we've seen all sorts of interesting structure. The typical structure is some sort of 20/80, 30/70, 40/60 split between the GP and the LP. You can have a pref on there. But we've seen special allocates appreciation and all sorts of fun stuff.
An investor puts in 100 grand and maybe gets 50 or $70,000 of his passive losses. Maybe take us through how do they use that, right?
So if I invest in a syndication and I receive a loss of any amount, the question is, can I use the passive loss? And let's assume that I don't have any other passive income. I don't have any other passive activities. That passive loss will be suspended and carried forward because I cannot use it. I'm not a real estate professional. I'm not material participating in anything. So I can't use that passive loss. But on the flip side, let's say that I built out my own real estate portfolio. So I have 5 duplexes and I self-manage those 5 duplexes. And let's assume that on those 5 duplexes, I've materially participated and I qualify as a real estate professional. So those 5 duplexes are non-passive activities. When I then go to make a syndication investment, I can make an election to aggregate all of my rental activities into one activity for the purpose of the Section 469S. So what that means is if I put $50,000 into a syndication, when I've already qualified as a real estate professional and I already materially participate on my own portfolio, I can aggregate in the syndication investment into my overall portfolio. And then I can take a loss, a non-passive loss from that syndication investment. If I don't make that aggregation election, what happens is that syndication investment will still be considered passive. So even if I'm a real estate professional and even if I materially participate in my own portfolio, if I don't make that aggregation election, I still might not be able to use those loss. So by making the aggregation election, what I'm effectively doing is I'm recharacterizing that loss from passive to non-passive. and then I can take that loss. So what we'll see a lot of our clients do is build out their own real estate portfolio. They'll self-manage it. They'll do all the repairs. They'll coordinate with all the tenants themselves. It doesn't have to be a substantial portfolio, but one that will drive you to their 750-hour test in more than half the time, qualify as a real estate professional. And through that, they're also materially participating. So they have that non-passive portfolio, and then they'll go and place syndication investments to boost their current year loss.
And that's something that's very common that CPAs will not get on board with, the aggregation or that grouping. Probably where you need a new CPA to figure it out.
There you go. And if your CPA ever challenges you on that, then I would ask them to go fill out form 8582. That's where all these losses get aggregated and see what they say after that.
Hey, good point. We talk a lot about this stuff on these podcasts, and we're just giving you the ideas and the ammo. I always tell my folks in my mastermind, look, you guys are empowered with this information. Your CPA to me isn't really a tax planner. They're not planning for you. They're there to do your paperwork. They don't know what deals they're going into. They don't know how much passive losses they're going to be. They don't know what the time horizon or the risk reward profile of those deals are. It's unfair for them to be able to tax plan out in the head. This is your job. This is your number one cost in life. You need to do it yourself. But these are the building blocks of starting to do it by yourself, steer the ship on your own. So people ask, I'm a high paid professional making over $200,000, $300,000 a year. How come I can't get these passive losses, or PALs for short, and offset my active W-2 salary and bring that gross income down?
Yeah, the most simple way to explain it is that you W business income or gain, stock sales, interest, dividend income, all of that income is considered non-passive. So I go out and create a passive loss. I can't net my passive losses against my non-passive losses. So my goal then should be to recharacterize my passive losses as non-passive. And there's quite a number of ways that you can go about that. One of which I just described, especially affecting folks that are investing in syndication. But that needs to be the goal at the end of the day, is how do I recharacterize my passive losses as non-passive if I'm trying to offset my other non-passive income.
And one of the big strategies that we like to use is the real estate professional status. It's like a two-part test, right?
Yes. Yeah. Two statutory tests and then a third hurdle that you have to get over. You have to spend 70 personal service hours in a real property trader business in which you material participation, personal service hours, real property trader business, material participation, 750 hours. The second,
So that means being an LP and 5 syndication deals does not work because you're not a managing member. But what are a couple of examples that you see, like you mentioned, a few rental properties? Does that work?
yeah, so let's talk about that syndication investment. So it's 750 personal service hours in a real property trader business in which you materially participate. Now, the syndication is going to qualify as a real property trader business, but your personal service hours, if you think about the litmus test of a personal service hour, what that really means is, or the litmus test for it is, if I did not log the time that I'm logging, or if I did not spend the time that I'm spending on this activity, the activity would fail. The operation, day-to-day operation would cease. If you're a limited partner investor, your personal service hours are not going to affect the underlying deal. So therefore, we're automatically out. But then we're also not materially participating as a limited partner. Just no way that we can. So whenever we invest in limited partnership stakes or syndication as a limited partner, we're not able to hit personal service hours for material participation. So if we're trying to hit 750 personal service hours in a real pocket trader business in which we materially participate, we're already out because none of the hours that we log against that activity will actually count toward that 750-hour test.
And then another thing that we'll just leave as a teaser for now is becoming a small part of that general partnership and being an active participation in there. But what about for moving on to rental properties? Somebody just owns a few of them.
That second test, that second statutory test for real estate professional status, is spending more than half your time in real estate than you do anywhere else, which typically will kick out for W-2 people, for business people, if you working part-time or not at all, in order to hit that second test. So assuming that you can hit both of those 750 hours and more than half your time, the next hurdle is to materially participate in my rental portfolio. The issue that we run into is typically not going to be an issue for landlords. Landlording is your only real estate activity, and whether you're landlording large projects or single family homes, you typically don't have to worry about the material participation tests. You're going to hit material participation on your way to 750 hours. But if you're a real estate agent, you're not materially participating in your rental portfolio, but you at the same time can still be a real estate professional because I, as a real estate agent, could spend 1,500 hours brokering deals all day long. That's a real property trader business. They are personal service hours, and I materially participate. So I meet test one, 750 hours. And by spending 1,500 hours during the year, that indicates that it's my full-time job. So I also meet test two. So I'm a real estate professional as a real estate agent. But what if I forget to also materially participate in my rental portfolio, then my rental losses are still passive. So what we like to see is pretty significant participation by either you or your spouse in the rental portfolio itself in order to hit those material participation tests. Or you do the landlording full time. That's all you do.
And that's a big misnomer, right? Because people think, oh, I'll just have my spouse get a real estate license and then just sell one house a year or something like that.
It doesn't
Not
work.
going to work. Other thoughts are that I think for more of accredited investors listening to this podcast, is it worth it to buy 3 crappy houses and be the landlord and get real estate professional status? In my opinion, unless your AGI is over 300,000, it may not be
Yeah.
worth it.
We have a progressive system, right? So I think 300K, the 24% tax bracket goes up to $317,000 if you're married, filing joint. So only after 317 are you taxed at, what's the next one? 32%. So if you're in like 32, 35, 37, okay, yeah, we want to get creative here and try to mitigate. But that's also similar conversation to what I've been having with a lot of clients. The CARES Act came out. Everybody wants these big net operating losses. And so they're like, how much real estate should I buy to create a non-passive loss that wipes out all of my income and then create net operating loss that I can then carry back 5 years? I'm like, sure, but 100 and whatever, $15,000 of this real estate loss that you have is only going to save you 10 to 12% per dollar. So to what extent do we want to create this loss? Like we want to maximize the savings. So we might not want to create a huge loss in 1 year. We might actually want to space it out so that we stay in that 35, 37% range.
Just to highlight that for people, if you're making over $300,000 a year, real estate professional status is definitely something you should be looking at. There's wonderful things that can come of this, right? You have one spouse making a lot of money, one that isn't. Perfect. That person can stay at home, take care of the family more. And actually, at the end of the day, the net on the financial statement is better because you're enacting the strategy. And I would say if you're under 100, maybe even $200,000 at AGI, this stuff isn't probably for you, which is why this is accredited investor mastermind at the topic. But I think for the lower net worth guys, the lower income guys, can you still take 25 grand of passive losses off of if you're making under 100, 150 or something like that? Give some of the lower income guys something to.
And I think that if you're in the 22 to 24% tax bracket, these losses are still beneficial to a degree. And for married filing joint, you drop into the 12% tax bracket if you earn less than that's that 22% threshold and 24%. So between 80,000 and $171,000 by married filing joint, I'm getting taxed at 22%. After 171K, now I'm being taxed 24%. So if you're in that threshold, I still think that it's potentially applicable. But to answer your question specifically, if you're earning less than $100,000, you have what they call a $25,000 passive loss allowance you can claim. You have to be actively participating. You also have to earn 10% of the activity. Active participation just means management decisions, a much lower bar than real estate professional status, than material participation. You don't have to worry about all of that. If you're earning less than 100, you get a full $25,000 passive loss allowance. As you scale up to 100 in earnings, that $25,000 passive loss allowance phases out. It phases out $1 for every $2 above 100K. So if I earn $110,000, I have phased out $5,000 of the passive loss allowance. Half of whatever my income is above 100 is how you calculate that. The first strategy is to manage my income. I can max out 401k contribution. We've had people at 150 contribute their full 401k contributions of 19,000 and or whatever that is in 2020. Make that full contribution, drop your income, your modified adjusted gross income down to 141, and now you just unlock 9,500 of that passive loss allowance that you can then claim. And that $9,500 passive loss allowance then yields another $2,000 or so in tax savings for you. So all of a sudden, my $19,000 contribution by 401k saves me a lot more money than it would otherwise because it unlocks some of this passive loss allowance that I'm able to claim. So if you're less than 100K, you get a $25,000 passive loss allowance. If you're more than 100K, that starts phasing out. And once you reach 150,000, your $25,000 passive loss allowance starts being phased down to $0.
And I think like most, oh, I don't know about most, but a lot of CPAs, especially the more conservative ones, will definitely say, yeah, you're not an active manager, or they'll kind of fight you on that claim. So you as an investor need to know what the rules are to get what you're looking for. Because if not, they're not going to check the box for you. And this topic comes up a lot, right? Like their CPA says, well, you're actively participating. And they're like, but you have a property manager. So they say you're not.
Yeah, you can be actively participating with a property manager. You might not be materially participating if you have a property manager, but those are two separate tests.
Right. Material participating, like you said, is for real estate professional status, but for what we're talking about right here, it is just active participating. You're making the shots. Somebody else is doing your dirty work, but you're calling the shots. This is tax time for everybody who's more of a sophisticated investor that actually files in October. Once you get your return back, this is the stuff you should be checking, right? If they maximize that $25,000, if you have the passive losses, and if
Right.
you're under that threshold. So this is where you have to keep that in check and kind of drive the ship.
We do make mistakes. I think everybody makes mistakes, especially when you're trying to crank through tax returns leading up to the deadline. But for the most part, we get it right and we ask good questions.
Yeah. And I know you guys share the same sentiment as me is you like to work with good clients that know this stuff as opposed to walking in and meeting the client. Those are bad clients to work with. Like you want them to know this stuff and you can work collaboratively with them, see what you guys can create.
Yeah, absolutely. And that's my new mission is to educate investors across the country and empower them to have better conversations with their own advisors. Bonus depreciation is going to start being phased out in 2022 or in 23. It drops to 80%, and then the next year 60, then 40, then 20 to 0. So I would expect at some point Congress to reconvene on that and try to figure out if they want to keep it or not. Bonus depreciation has been around for a while. Whenever it sunsets, it gets extended. We might see similar treatment again.
Yeah. And when you see Democratic or Republican Party, you're meaning the Senate, right? Just so that people get clear. Presidential, it's just a figurehead. Thanks for coming on.